Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929, our telephone number here. Save that number. When you have a question, write it down, and then after the show, give us a call. I will answer the phone, and I will let you know what the answer is. Ding! Yes, I have the answer. Actually, I don't have the answer to most things, but what I do have is experience. 20 years experience in the lending business and the real estate business here in Southern California has given me a perspective on not only today's world, but in what has happened in the past and what is probably going to happen in the future. Now, nobody's got a crystal ball. I don't have a crystal ball. But I do know that the trends we see in today's market match trends that we have seen in the past. The only thing I can't predict is what tomorrow's rates are going to be. So before we get into anything else, let's just talk about rates, where they've been, where they're going, and how that's going to affect your decision whether you're going to buy or sell a house. Anyway, welcome to the show. Thank you very much for listening and tuning in each and every week. KCAA, KMET, and K-Tahoe are three great affiliates in the state of California, also some parts of Nevada. We are in the Inland Empire mainly, where our 5 million plus listeners who can tune into the show each and every week are, sitting out there wondering what is going to happen with their house. It's not selling, or what is going to happen with their loan. Why is it taking so long? Or what is going to happen, with the buyer that doesn't seem to be able to sell their home so they can't buy your home. There's all kinds of questions, answers, solutions, things that you need to know about that we can help you with. And we do this every Saturday and Sunday during the week. We are on Thursday, I believe. Is it Thursday, Daryl? We're on?
I think it's Thursday, yeah. Saturday and Sunday for sure, and I think Wednesday.
Wednesday it is too?
Wednesday in Banning, yeah.
Oh, okay, excellent. All right, so rates, where are they today? Well, rates have been volatile, as everyone knows. That's a term that we use that means that we can't predict it. We don't know where it's going. It goes up and down, but steady up and down. So it's not more than 1/8 of a point to 3.375 of a point, which is 1/8 of a point, I guess, up and down last week. We had seen rates drop as low as 3.5%, 3.25% in some areas, FHA loans, to now whereby we've got a 30-year fixed-rate loan average across the Southland at 3.625% to 3.75%. Still very good rates. And what we have seen as a result of these rates is that a lot of people who got those loans, a lot of people who bought houses a year and a half, 2 years ago, last year, are seeing a significant drop in their payments and without a lot of loss in the amount of money they've already paid towards the interest rate on the loan. And that's a good thing. I mean, if you can find a payoff whereby the difference between what you have already paid in interest and how much money you're saving, and that turns out to be a year and a half, 2 years, maybe 3 years at the outside before you start seeing the benefits of that, that's pretty good. I mean, when you're considering it all done. If you're in for 30 years, what's 3 years, right? It's 10%. So 90% of the loan will be paid off, making less payments or making lower payments than you're currently paying. So I think that's probably a pretty good deal. But when you get into the 5-7 year return before you can see any positive nature of the payment that you're making each and every month, that I'm not sure whether that is something worthwhile to talk about. So all those things considered, give us a call. We can certainly help you, 888-713-2929, in terms of determining that. Pretty easy calculation that we can walk you through, or you can just Google it online, as most people do. And I'm sure there's a YouTube video on it, although I haven't looked for it. By the way, the show is on YouTube. We shoot this show for the TV show, the stations rather. A couple of the stations carry a video feed. So if you're looking to see this show, see the great guests who are on the show, you can go to KCAA or KMET, and they both carry the feed. And we are also on YouTube. If you go to Jeff Barton, the Mortgage Voice, on YouTube, you will see our channel, and there are many, many shows archived, as well as the current show, which will be airing this weekend, November 9th, 8th, something like that.
Yeah.
Yeah. Yeah, exactly. Yeah. It's something like that. Anyway.
Is that
Okay.
reassuring?
It's very reassuring, and thank you very much.
Saturday's the 9th and Sunday's the 10th.
Okay, excellent. All right, so we got into 30-year fixed, 3.625 is the low end, 3.75 is the high end. Still very good rates. The FHA rates are 3.375, and those are terrific rates. As you know, the payment on that is going to be increased because there is the mortgage insurance premium that you have to pay, and that is divided up on a 12-month basis. I think it's a point and a quarter on top of that for the yearly, and then you divide that into 12 months, and so your payment is such as that. The 15-year fixed is 3.375%, and that's, the 15-year. I did a 15-year. Anybody that's listened to the show knows that. 15 years is a great loan. Let's say that you're into the loan for, 10, 15 years, but you need a cash out. You might want to look at that 15-year cash out refi. That's a pretty good loan. Now, whereby you've probably gained some equity in your home, you want to take some of that money out. The 15-year loan will allow you to be able to pay that loan off in similar fashion if you can make the additional payment, the amount of the additional payment. But since you've been paying in for 15 years, the principal has probably come down some. So this is what I like about that loan. Plus, there's less interest payments. You pay into principal much quicker, and you pay that loan off very quickly, almost in the same time with the cash already out, if you can afford the increase in payment. That's a pretty good loan. Also, the 5-year ARMs, the adjustable rate mortgages, 3.25 to 3.75%. So, we've been dealing with the rates that have gone up a little bit in the past couple of years, past couple of months, past couple of weeks anyway. But they are still pretty low, below 4%, which I like a lot. Anybody, as I said, who is looking for that, special time to buy, now is the time to buy. One thing about Southern California real estate is tight, job market's tight. And this I read on Mortgage News Daily, the site we go to each and every week, plus on all the economic news that I look at for preparation for the show. There's a lot of economic news in consideration when you're looking to buy a house, right? You want to make sure that your job is secure and safe. So let's go to the job numbers. What are they? Well, historically, we have seen very few times in the history of these numbers where the jobless rate has been so low. We also see that the numbers for the amount of people employed is at the highest we've ever seen. Now, does that mean that they're the greatest jobs in the world and that everybody's happy with their particular lot in life when it comes to employment? No, that doesn't mean that. What it means is that based on historical numbers, we are seeing a very, very strong market. So if you have a job, and whatever your job is, it's probably pretty secure. There are some jobs which, are obviously going robotized, and obviously the AI in certain sectors of the economy is going to be affecting over the next 10 to 15 years. But if you're in the healthcare world, if you're in the financial services world, if you're in construction, if you're in any of the trades, whether you're a plumber, a carpenter, electrician, all of these type of jobs look strong in terms of continued employment. And certainly in the high-tech sector, certainly anybody in banking, anybody in medical supplies. I mean, there is a list of companies, and you can Google them. I'm not the only one that knows this, but you can figure out what is your best path to maintaining long-term career stability. If you're in retail, I would say that that's probably not a great and stable job for the next 10 years or so, 15 years. As you know, everybody knows the retail sector is down and the amount of big box stores going out of business increases. But like I say, with this type of economy, this type of employment, and the prospects of the future, if you're in those fields that I just mentioned, your 30-year fixed-rate mortgage is probably pretty secure. Why? Because you're a good risk. You're going to get your employment check. You're going to get paid each and every week. You're going to get paid on time, and it's going to last for a long time. So that and a good credit score is probably going to get you a smoking rate. Now, if you're in a different type of job, a different type of circumstance, let's say you're self-employed, let's say you're the type of person who owns their own business but writes a lot off on their taxes. We talk about this every week on the show. Those type of people are going to pay a little bit more in terms of the rate, but the money's out there, and you can even get up to 80-85% of a loan to value with only 10 to 15% down. There are even some bank statement loans right now available for 10% down. And I think I even saw some stated options. Now, what does that mean? That means you are telling people what you make, but the amount you have in the deal is higher. So if you're looking for that, we can help you. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks for tuning in this week, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. We have a telephone number. If you write it down and you have questions during the interview or during any part of the show, you can call us after the show, and we'll be happy to answer any and all questions. 888-713-2929 is our number. Dun, da, da, da. And also, we have an email, info@malibufunding.net. I'm Jeff Barton, as I said. We're on YouTube. I've got Twitter, at Jeff6493. A number of different ways that you can get in touch with us. We do want to hear from you. Why? Because without you, we can't really know what exactly you want to hear from the show. So we just go on our merry way, and we don't know if you like it or you don't like it. We certainly want to be informative. Main thing here is to try to give you information to use out there in the real world when you're trying to decide, do I buy now? Do I buy later? Do I refi now? Do I refi later? A lot of it is dependent on information that is out there, like the rate. The different lenders will have different programs, but you need a trusted advisor. And I bring to the show one such person who has been on the show several times, many times over the years, Jennifer Conrad, who is a loan officer, terrific processor, and is a multi-state expert on how to get a loan done. Jennifer, how are you?
I'm well, Jeff. Thank you so much for having me.
Thank you very much. All right, tell us a little bit about what is happening in the marketplace in order to get somebody who needs a loan get done.
Well, actually, the rates are really good.
Yeah, they are.
I was looking at them, so, yeah, I mean, we can do a 30-year fixed conventional at like 4%, and even a 15-year down at like almost 3.5%, and then the FHA at like 3.75%. So
right.
It seems like there's, a lot of people who are interested in purchasing still, have the option to be able to do loans with like 5% down. Obviously, we would like to have at least a 680 credit score in order to make it a situation where it doesn't end up costing the borrower, too much money to actually get it done. And it's the standard stuff. I mean, 2 years tax returns or W-2s, 30 days worth of pay stubs, and 2 months bank statements showing you have the assets, even if it's a gift that's being given to you by a family member. To be able to handle the purchase.
Gift. Talk a little bit about gift and what that means, because a lot of people get confused about, okay, I don't have a down payment, but someone's willing to give me the money. How does it work? Who can give the money? Stuff like that.
Okay. Well, a mother, father, sister, or brother can give a gift. There have been some cases where, like, if you have an aunt that wants to give it, but generally speaking, the rule is mother, father, sister, brother.
Okay, immediate family, right.
Yeah, and so then what we're looking for is that they've given you a check, and then you have taken that check, made a copy of it, deposited it into your bank account. Once it's in your account, you deposit the whole amount, not part of it, but all of it. And then we want to make sure that we actually see that it has posted to your account, not that it's pending, because sometimes people will print out something from the bank and it'll say it's pending, but it needs to show that it's actually posted and those funds are available. But we also have a form that they will sign basically saying that they've given this to you as a gift, there's no type of repayment, but then they also need to be able to provide for us a bank statement showing that they had the funds to be able to give, because we want to make sure that they're not making just a large deposit of what we call mattress money, which a lot of people do, where they keep a large portion of money in the house and then deposit it in. We want to be able to see that they have consistently had, this amount of money in their account for at least 60 days. So once we have that, then that covers the down payment and we're good.
Okay, so that's good, and I thank you for explaining a little bit about mattress money. I read an article that says that the Chinese are going to a cashless society, and it was a big article. I don't know whether that's true or not, but based on that, do you think we'll ever get to a point whereby a lot of this mattress money stuff goes away? I mean, because I know a lot of people just don't trust U.S. banks, especially if we have foreign citizens or newly immigrated people. They just, based on wherever they were or where they came from, having money, as you say, stashed away is always the safety net for them.
It might be, but I've been in the industry well over 25 years, and it's always been the same thing, that the money has to be, in your bank account, which makes sense. I mean,
of course,
everything needs to go through, FDIC and making sure we know that the money that is in our system, is money that's been here, that's circulating as it's supposed to. And so, there's no questions about it. And I think, lenders are probably even more guarded since everything that happened in 2008. And everybody just wants to make sure that everything's across the board so that we don't have lenders that are, get into situations like some of the lenders that are no longer in business for some of the practices that they did. So I don't think that's going to go away. I think that's something that, we should just be prepared for if a person wants to purchase a home. But I think that people can be proactive about it because in a lot of cases, you're starting out 60 to 90 days before you really anticipate on closing on a house. So even if that's the case and you have family that's putting money into their account, the whole idea is that it just needs to be there for 60 days. So you put it in, you make sure you keep it there, you don't touch it, and then we just make sure that we get a transaction history and bank statements, that are going to be close to the time that you're going to close.
How often are you providing solutions for people like this? I mean,
99.9% of the time.
Right, exactly.
But in a lot of cases, and I'm trying to tell people, even if you have, questions regarding where your credit is, instead of saying, I know my credit's bad, I won't be able to buy, it's better to call and talk to us. Let us look at your credit. We can a lot of times look at your credit and give you suggestions of things you could do to put yourself in a situation, and we can give you a rough time frame of if you do this, it might be something where you'll see a change within 3 months or 6 months. And then that way it at least lets you know that you're on the board to be able to try to purchase instead of, saying that you don't qualify and not even have a real understanding of the industry.
Now, you do loans in a number of different states, as I stated. Where are you seeing the real estate market? Strong, soft, tight? What do you see out there in terms of availability of housing?
A lot of the stuff that I'm doing is in Virginia and in Illinois. Virginia and in Florida right now. So it seems like as far as like the Florida situation, it's mostly condos. And there are a lot of condos going up, a lot. So I'm not seeing too many single-family homes. Whereas in Illinois, it's a bit more single-family homes, but they're not new construction. In that case, they're homes that have been there for a while, and it's just, being turned over. But, my experience has just been that that's pretty much the two areas that I'm seeing the most.
I see. Biggest problem in getting someone qualified today is what?
Undisclosed debt.
Undisclosed debt. Yeah. Yeah. Oh, I forgot to tell you about that other house I own. Yeah, I know. Jeez.
Yeah. So twice this week.
Mm-hmm.
I know that, obviously underwriters have, their own systems that they're able to do their checks and balances, but, had a file where it just seemed like everything was across the board, 40% down. Everything's good. The underwriter comes back and says, hold up, you guys didn't tell us that you had another house somewhere, and I had the 1003 prepared a certain way, had the borrower sign it, and they were saying, hey, we don't want to approve this loan, even though I said, well, I'm sorry, maybe it was something I missed, and they're like, no, the borrower signed an application stating this, so if they signed it, they didn't read it, or they didn't tell you, then that's a problem.
Right.
So, people have to understand it's a very real issue. If you have, a situation, you went out and decided that you were going to buy a car, and it has not reported on your credit yet, but you don't tell me about it.
Right.
And then all of a sudden, the underwriter pulls something, and then I'm sitting there like, well, I didn't know anything about it. We talked about this. The borrower told me there's no additional debt. It can actually put you in a situation where you won't get that loan.
Yep. And I think anything you can do to help the loan officer, we're all on the same team here. We're not fighting each other to try to hide. And anyway, Jennifer, we're up against the clock. Could you shout out or tell people how they may get in touch with you?
Sure. My phone number is 773-593-6831, or they can call the office, and you all can patch people in contact with me in the office number 818-719-9901.
Okay. Jennifer Conrad from Malibu Funding, thank you very much once again for being on the show.
Thank you so much for having me, Jeff.
Okay, and thank you. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929, the telephone number. Email address is info@malibufunding.net, at Jeff6493, and we're on YouTube as well. We have a blog, although it's not up. We're working on it right now. We're trying to coordinate everything to be one sort of boat going forward, rowing in the same direction to give you the information that you're going to need in order to get what you want. And that is usually a very low-priced loan with a terrific rate, delivered quickly, on time, so that you can make everybody in the real estate transaction, if you're buying, of course, very happy. In order to do that, we need great people. Let's face it. Great people in this industry, they're out there. You have to find them. You have to interview, but they're out there. Believe me, I have 50, 60 of them that work here at Malibu Funding. Malibu Funding is the company that sponsors the show each and every week. Thank you, and thank them for being able to have me on the air to deliver you this message. Their NMLS number is 79620, and again, I'm Jeff Barton. With us today from, where are you from? Phoenix? Is that where it is, or is Scottsdale? Where are you, Nina?
Phoenix, Arizona.
Phoenix, Arizona. Nina Penny, who is a terrific loan officer for Malibu Funding, and we're glad to have her once again on the show. Nina, how are you?
I'm doing great, Jeff. Thanks for having me.
Thank you again. We talked off air about the number of Californians who've decided California is too much for me, and they've decided to come down into your neck of the woods. Give us some of the, I guess not stats, but some of the anecdotal information that you're getting from the realtors and the people in the business down there.
Well, we're finding that a lot of people in areas like Prescott, Arizona, Tucson, Arizona, people are coming over from California that are just kind of tired of living the California life, you know?
Mm-hmm. I do know. And we know what the California life is. Anybody in my listening audience, in my listening area, knows that there's high taxes, there's a lot of red tape if you're trying to do anything. There's just seems to be an oppressive environment if you're a firearms enthusiast, or if you're, like the open air and the freedom to do what you want to do. And that's the lure down there, isn't it? That it's more, they leave you alone and you can do what you want. Isn't that kind of what Arizona sells?
State.
It's
yeah.
what?
And it's a free state.
Right,
when
right.
it comes down to, certain things, and our taxes are better, and
right.
We can make a list that's pretty long there, Jeff.
Yeah, you know what? I love Arizona. I have family down there. I've had a license down there for many years. I enjoy the business, enjoy doing business down there. Give us your ideal customer that you usually work with when you're working down either in the reverse mortgage field or in the forward mortgage field.
Well, like in the reverse mortgage field, what we're finding is a lot of people selling their homes in California and maybe, being able to walk away with, a good chunk of change, come to Arizona and find that they can have a house that's just as nice as what they just left at a lot less of a price. And they use a reverse mortgage to maybe come in with a one-time investment of approximately 50% and allows them to hold on to a lot more money and enjoy never making a mortgage payment.
Okay.
Or some people use. Yeah.
No, I didn't mean to interrupt you, but I was excited when you were talking about reverse mortgages for purchase of a home.
Yes, it's a lot of people don't know it, but a lot of people now that are coming to move here, because it's so much, the prices are home prices are increasing, so they're finding themselves weaning out of the market of being able to buy something that they love.
Right.
So the reverse allows them the opportunity to get back in that price range that they want to be in.
Okay, explain the nuts and bolts of it. How much down? You said 50%?
Well, normally I like to use the average that the initial senior would be coming in with an initial investment of approximately 50% of the sale price, and that would include closing costs. The older they are, the less they would be bringing in. But I like to use 50% as an average. So they find a home that they like, they can make that one-time investment, and then they're not obligated to make another payment. For a lot of people that aren't really aware of what a reverse mortgage is, it's just simply an FHA loan that you're not obligated to make payments on. You can if you want, but you only have to pay taxes and insurance.
And so the qualification for a loan like this, how would you qualify for it?
Well, we work off of what we consider residual income. So we do look at credit.
Okay.
But our underwriting is a lot not as strict as conventional financing. So we look at that. We look at funds to close and the ability just to be able to keep up with taxes and insurance.
And that calculation is readily available? I mean, how do you figure that? Just based on what they make from their residual income or their fixed incomes, either Social Security or some other kind of 401k or something like that?
Sure. Well, there's a couple of different ways, but I'll just give you a quick rule of thumb.
Good.
Let's say on my Social Security I get $2,000 a month. And that's all my income. Okay? And let's say, taxes are $1,200 a year. That's $100 a month.
I see.
And let's say, insurance is $100 a month. So that's $200 a month, and I have a car payment of $200 a month. So now altogether, my living is, figure $500.
Right.
And then residual income, let's say I'm a single person, we need to calculate you have $595 left over.
Right.
And as long as you do that, you pass residual income.
Okay, that seems right. It seems simple enough.
Underwriting is a lot easier than traditional loans.
Yeah, it sounds like it's a lot easier. And also, as you were saying, you're selling a high-priced house here in California. You're moving there. You're paying only half of what the house is worth there, which is probably a little less than what you paid or what you sold your house for here. So you're maintaining money in your pocket. You're not making another payment. You still have equity in your house because in today's market, the equity is going up. It's not going down.
Exactly.
Right. So
and the greatest thing about retirement and what a lot of financial advisors like to pinpoint to people is that when we go into retirement, we're not earning any more money.
Right.
The only thing we can do to have more cash in our pocket is to eliminate debt.
Right.
So using a reverse mortgage allows you to come in with approximately 50%, never make a mortgage payment if you don't want to, and still have cash left over.
Now, Nina, explain to the listening audience, once again, those who have not heard you on the radio before, the education requirements for your particular type of certificate and licensing, which is way beyond what most people who do reverse mortgages have.
Sure. I'm a certified reverse mortgage professional. There's only 143 in the United States. So we work closely with the National Association of Reverse Mortgage Lenders. We have a certain amount of classes that we need to take, a test which is very difficult. A lot of people don't get it passed on the first time. We have to keep up with credentialing, education.
Right.
We also have to have so many loans under our belt, and we have to, make sure that our credentials and our past history, we have good letters of recommendation from industry leaders.
And we say this all the time. It's about what you know. It's also about the certifications. I mean, reverse mortgages are an important part of the marketplace, especially for older people who, like you say, they're on a fixed income, right? You want to make sure that these people understand what the structure of the loan is. So in order to do that, having more advanced, degrees, as you would call it, is very, very important. And so I wanted people out there who are listening to understand that what you have is something, like you said, 3 people in the country have it. So this is extremely important.
You know, Jeff, somebody once put it to me this way, and I think it's really kind of true. If you're going to get your taxes done, would you want to go to a bookkeeper or would you rather go to a CPA?
That's exactly right. That's exactly right. Hey, could you shout out your phone number for people who are listening who want an expert in the field? And you do reverse mortgages everywhere, yes?
Yes.
Yes, exactly. But shout out your number for them.
My telephone number, my direct line is 480-635-2410. My website is www.simplereversemortgage.net.
Thank you very much, Nina. Thanks for coming on the show. Once again, great information, and we'll see you soon, huh?
Yeah, thanks, Jeff.
Okay, bye. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
Listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929 is our telephone number. If you save that number, write down your questions, call us later. We'll be able to help you. We'll help you with the information that you're going to need, right? You got decisions to make: buy, sell, hold. And with my next guest, the reason I said it like that is because we spent some time together in Las Vegas. Buy, sell, or hold, right, George?
Oh, yes, sir. That's what I like to do with the dice. Buy 'em, sell 'em, hold 'em.
Exactly. Anyway, on the show with us from the Inland Empire is our great friend and terrific loan officer is George Gonzalez. And again, George, how are things going? How's your business?
Everything is going good right now, Jeff. You know, as you know, interest rates are super low. New programs are coming out for our new crowd that's coming out, the self-employed crowd.
Right.
You know, where, you know, they're coming creative a little bit with helping these guys get financed instead of just using basically, their taxes.
Right. Tell us. Give us an example.
Example would be you've got a guy who's been, he's a construction guy, has a construction license, had it for 2 years. Basically what we would use is we can use the average deposits into his business bank account for the last 12 months or 24 months, depending on credit score and whatnot.
Right.
Obviously the one thing in common with all the loans is you still need a down payment, which is good because you always want these people to, everybody to put something in the game so that they take care of it, and manage it accurately.
Right.
But that's basically it, man. And the rates aren't too bad from, these conventional loans.
Yep.
And some of these clients are like, well, George, this other bank is offering this. And I said, yeah, but that's if you're showing them your taxes. Because if you show them your taxes, then you got to show the big guy your taxes, and then it might be a little higher payment than what you're paying if you get this other loan.
Oh, I absolutely know. I think a lot of people forget that when you have a hybrid type of loan, which is what this is, right? If you're doing a bank statement program or some kind of stated loan, or you're doing equity-only loans or some kind of other different loan products rather than a 30-year fixed rate, 20% down, taxes, you're going to have to pay a higher rate, but it really isn't all that much higher.
No, not at all. Not at all. I mean, too many times, people are rate driven.
Right.
Just look at the payment is what matters. The rate, you're talking about maybe $100 more a month or $80 more a month.
Right.
But there's just too much hype on, I got the lowest interest rate and I got this and that. But, that's all here and there.
Well, it's okay if you've got that type of job, but there are many people, like you described, this guy who owns a construction company. He's not reporting 100% of his income because he's using his business to write off expenses. Like, does his business have 3 cars? No, his wife's driving one. But okay, he's writing it off. I mean, but this is what happens in the real world, and we all know it.
Right, exactly. And so the banks are pretty smart. They say, okay, guys, we'll let you finance. We know you're making money.
Right.
And, but here's the penalty you have to pay. It's going to be a little higher rate because it's a little higher risk on their end. Right.
So rather than, a 3.74%, you're paying 4.5%. Right.
4.5 to 4.75. Exactly.
Right.
Less than a point difference.
Right, and I think for those people who have rate on their mind, there are lots of competitive outlets out there, as we can be competitive because we lend our own money as well. If it's needed that way, rate can be something that you can also take care of, right?
Oh man, we just locked in. If you're going to go the conventional way, or what we call FHA, the minimum down payment is 3.5, which
right.
is a very popular program, and I just locked somebody in actually this morning at a 2.875 at par pricing. So it's
wow, that's smoking.
Wow, 2.87. Are
wow.
you kidding me? Like, it's unheard of.
Well, unheard of in the past 4 years. Yeah, I mean there was a time, but that ship had sailed. This is pretty good, very good pricing. 2.875. Wow, that's pretty good.
Right. And see, and then I found out like, a few of my past clients called me and said, "Hey, George, I got a bunch of equity in my house. I need to cash this out because I'm going to buy something else.
Right.
And, I want to make my equity work for me, not just sit in my
That's
account,
right.
or sit in there." And that's what the big rush is right now is people are wisening up. They're talking to investors or they're talking to somebody who's telling them, listen, that money, you have a bunch of equity. You can brag all you want about it, but it's not doing nothing for you.
Right.
It's just going to sit there, and so you might as well make some money if you want to, if you're that type of person,
Well, you have to have an ability to handle risk, right? There's risk in all markets. Any market is going to tell you, and nobody's going to say this is 100% slam dunk. But if you're in the real estate world, the one thing you do get if you are using that money to buy additional real estate is you have the property. You always have the property, and the property is something that's worth something.
Always.
Right, always.
Like we went through, that market we went through when it went
Correct.
down or whatever. But, shoot, those people are thanking God right now that they held on to it or they bought
right.
one at that in 2012 and 13 because that's when they seen the biggest spurt.
Oh, man, if you bought 12 or 13, it's 6, 7 years ago, you're feeling really happy right now because you've got plenty of equity. You probably took some money out. You still have plenty of equity, and your rates probably went down. It's amazing.
Exactly.
It's one of the most unusual markets I've ever seen in the business, whereby you're making more money, you're paying less for it. It's just amazing.
Right, and then on a kicker on top of it, Jeff, where I'm like, wow, is the values aren't going up like they were. They're kind of steady right now, so it's kind of a
tell us
strong
about
market
that
for buyers.
Right. Tell us about that because I was interested about the real estate prices in your area. And George is out in the Inland Empire. You're in Rancho Cucamonga. Right. I don't know why I was thinking Rancho Santa Margarita, but you're in Rancho Cucamonga.
Rancho Cucamonga, North Fontana, Upland, North Ontario, Alta Loma. These are the areas that are the most desired out here, you want to say, in the area. And, yeah, they're kind of on a stagnant. They're not going up, but they're not going down, definitely. But they're pretty much across the board. They're staying pretty steady right now on pricing.
Well, that's good because when the rates went down, that means you can buy more of the house you want. A lot of times when the rates go down, the prices are going up, so it kind of equals itself out. But in this particular case, it looks like you can buy more house because the real estate prices are remaining constant.
That is correct. It's easier to qualify, obviously, with less debt on the payment, or less payment on the month.
Right, exactly. Okay, so where do you see it heading? I mean, we're having a couple pretty good months, 3, 4 good months in terms of the lending business. Real estate seems to be steady. Are we looking at this long term, or what are we seeing? Is it through the election? I'm just always curious as to how my loan officers and the loan officers out there are looking at the economy.
Well, on my end, and my personal opinion is, we're going to try to keep America strong.
Right.
Keep going, and everybody's doing business right now. People are actually not scared to do business. They see it's been long enough.
It's been long enough. Yep.
Yeah, they were scared of the market before. Okay, it's long enough now. You see your family, you see your people succeeding by buying properties and being happy and fixed 30 years where it's not going to change. The rate they get, that 2.875 I got today, they can never have to touch that in their life again.
And I wouldn't. I'd try to keep it for 50 years. That's a hell of a rate. Jeez, that's amazing.
100%. Like, okay, well, the 15 years, let me get this 2.875 again. After I pay it down, let me get some more money out of 2.875.
Right.
But who knows, But as far as I can see, Jeff, I mean, it looks like we're good because I still have a pipeline of people to call who they're saying, George, we're on the fence and we're not this. Give us till January 2020 or after the election. We'll see what the market goes. Whatever.
Yep.
Call me when you're ready. But you'll be ready soon because everybody's going to pass you up if you don't make a move.
Listen, could you tell people how to get in touch with you if they want a terrific loan officer out in that area?
Yeah, my direct line, cell phone is area code 909-900-9565. And my direct email is georgeglending, LENDING, @gmail.com. Or you can also go to MalibuFunding.net website. You'll search my name under loan officers, and all my information's there too.
George, thanks very much for coming on. I really appreciate it. Also, the outlook for what's going on in the IE. Thanks.
Thanks, Jeff.
Okay, very good. That's George Gonzalez from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. Write down the number. Call us after the show. You're going to have questions. Okay, we talked about different things during the show. Great guests, as always, come on and explain what's happening in different aspects of the business, whether it's in the reverse or whether you're looking for a terrific loan out of state or whether it's the Inland Empire's own George Gonzalez. We would like you to be able to ask them directly. So if you go to YouTube and you check out Jeff Barton, the Mortgage Voice, you're going to see these interviews that we did today on the show, and up next to the people who are doing the interviews is their phone number. Now, they usually say it over the airwaves, but if you do not catch it, you can go to YouTube and write it down from what they say. As I say, George's own out there, what's happening in the IE with prices in real estate, what's happening with the real estate, not only the real estate, but the interest rates being so low, and what the opportunities are. Anybody who's in the business will tell you there are opportunities in each and every market. If you can afford the payments now is a good time to buy. If you're looking to sell, step down or step up. It's always a cyclical process of the real estate world, and whatever is high today will be low in the future. Now, let's talk some about what we're seeing with delinquency rates, because those delinquency rates are usually foretelling what is happening in the overall economy. Obviously, the big parameter is if we have a large-scale problem, let's say there's a terrorism or some kind of weather or some kind of disruption in the markets, you're going to see unemployment go up, and therefore you're going to have more delinquencies because people can't pay their mortgage if they don't have a job. Aside from that, and I'm talking about, of course, 2007, 2008, 2009, the really dark times in the past, 10 years ago, 11 years ago, what we're having now is pretty strong employment, as we talked earlier in the show. But the delinquency rates themselves reflect what's going on in the economy now and in the future. So I'm just going to read off a few statistics. Got this from Jan Swanson, our friend who we've never talked to. I'd like to get her on the show, but we're not, from Mortgage News Daily. And what we have is, let's go back to 2015. We have about 0.5% of the loans that are done in that particular year in delinquency. Now, what does that mean, 0.5%, in terms of numbers? Let's say we're doing 5 million loans a year, give or take. We're doing a little more, we're doing a little less, but let's say we're doing 5 million loans in the U.S. per year. Well, that's a lot of loans, right? And 5% of that would be, anybody's guess? 500,000, 250,000, right?
10% would be, 5% would be 250.
250,000 loans a year in delinquency on that year. Now, what does that really mean? Delinquency means that you get a notice from the lender, from the bank, from the servicer that says you are late on your loan. That's delinquency. That doesn't mean foreclosure. That just means that you're late on your payment. So that's a very low number. Historically, those numbers are 3.5%. If you look at the average of delinquencies, i.e., people who are late 30 days, 60 days, 90 days, over 90 days. And serious delinquencies are over 90 days. Well, when we're talking about delinquencies, we're just talking about people who have a notice of default, meaning that, hey, you've missed a payment, what's happening, and that's where we are. So in 2015, it was 0.5%, about 250,000 loans. So if you look nationally across the country and divide 50 into that, you get how many are in basically each state. So it's really a pretty low number. Today's number, 2019, is 1%. So that means it's 500,000 this year. Now, that may seem like a terrific upswing, doubling it since 2015. But when you look at the historic numbers of really 3.5% delinquency rate, 1% is incredibly low. And these numbers trending that way have been doing so since really, well, let's look at the chart here for a second. 2010 is 0.8%, 0.7, 0.6, 0.6, 0.7, 0.5 at 2015. So really it's been low. Now the trend number is up. Now granted, it's only 0.2% per year, so it's a small tick up. But what does that reflect? That reflects a broadening of the real estate lending market. One thing I wanted to say. In the U.S., the main players in the mortgage business. Now, everybody's heard of Quicken Loans, right? Everybody's heard of, maybe not everybody, but United Wholesale. Everybody's heard of Stearns Lending. Well, Stearns is a little bit in trouble, from my understanding, but everybody's heard of all of these lending institutions, I'm sure. And there are a number of them, and they're just like Malibu Funding, meaning that they have a license to lend money, and they lend the money, and they take those loans, and then they sell them to Fannie Mae and Freddie Mac. That's the basic model of what any small-scale lender, mortgage banker is, up to the big bankers. 70% of the loans in the United States are done by people like Malibu Funding, like Quicken. We have the same licensing, just a different, obviously number of loans that they're doing per month. That's a big number. One of the interesting things that happened during the Great Depression, recession back in 2007, when a lot of banks, over 350 banks went out of business. They really weren't banks. They were mostly mortgage bankers and people like Malibu Funding or like Quicken, like a number of these people. The interesting thing at that particular time, when we were looking for any sign of, what was in trouble, what wasn't in trouble, was that we had about the same number of loans being done by non-banks at that time. About 70-80% of the loans were being done by mortgage bankers. Now, which is fine, right? Banks shed those businesses very quickly after the recession happened. Why did they do that? Because mortgages are exposure. What do I mean by exposure? These fancy words. Well, if you lost your job and can't pay your mortgage and Bank of America has your loan, guess what? They now have to call the loan. You don't have any money, so they're stuck with it. So that's a problem for them because they have to buy back the loan from Fannie or Freddie. And, as everyone knows, there were massive losses of all the main banks at that time. So we fast forward to 2019. So why is this important? Because at 70% of the mortgages being done in 2019 by Quicken, Malibu Funding, non-bank lenders, if there is another recession, there is going to be a quick trigger to stop any extension of credit to people like Malibu Funding who lend their own money, or Quicken, or United Wholesale, or Stearns, or and PRMG, or anybody else who is out there in the marketplace, which means that loans are in the pipeline looking to be funded, stop being funded. Now, I bring this up because this is what is similar to back then. The loans are different, the economy is different, all this is different, but it's something to be aware of when you are in line to get your loan funded. That's why we talk about the economy. That's why I like to keep people who listen to the show up to speed on what's going on nationally as well as locally, because the trends that are happening really affect you if you're looking to purchase a home, because you want to make sure that whoever you're using as your lender, and as I said, 70% of the lenders out there are just like Malibu Funding with the same kind of mortgage banker licensing, that their particular credit lines, whether they be 100 million credit lines a quarter or $1 million credit line per quarter, are still able to be shut off very quickly, because the large lending institutions, Bank of America, Wells Fargo, Chase, Citi, they're the ones who are lending the money to the mortgage bankers. And if the economy goes south, they will be cut off immediately, because the exposure to those type of companies is only in the amount of money that's in the credit line to Wells Fargo or to Bank of America. So these are things that we keep trends on. Right now, I do not see anything happening on the horizon that looks like it might be a problem. So that's a good thing. But keep abreast of it. Keep looking at it. You're looking at stock market. You're looking at bonds. You're looking at all things related to mortgage rates, which of course are the treasury bonds, mortgage-backed securities. All of these things that we talk about relate to you right now looking for a loan, and the lender looking at you, can this person pay back a 30-year note? Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. I really appreciate you listening each and every week, and thanks again, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.